I was just looking at the total increase in interest rates from the day the Fed cut rates on September 16th. And today we hit exactly 100 basis points. So the 10-year yield is up precisely 100 basis points from where it was when the Fed decided to start easing. So the markets are tightening while the Fed is easing, and it is always that way. But this has been particularly profound because this really brings me back to Greenspan and what ultimately birthed the Greenspan put. And that was, Greenspan was appointed in September of 1986. And one of the first things he did was start raising interest rates. And from September 86 all the way until October 1987, bond yields, the Fed tightened, I think, 300 basis points. Interest rates went up massively. And the stock market just kept flying in the face of it until October of 1987, when it obviously the floor fell out from under it and it just couldn't avoid that gravitational pull any longer. And that experience so chastened Alan Greenspan that he became father of the Greenspan put, and always and forever after that erred on the side of accommodation over restraint. So I think that is very much ingrained in my memory. And I think that when I see the stock market go up in the face of rising bond yields, it definitely puts me on the edge of my seat waiting for, when what's going to hit the fan. The one difference now is that when you look across the credit markets, obviously it hasn't been as profound. In fact, junk bond yields are only up 25 basis points from when the Fed first started easing. Now they're up, which again, flouts the Fed easing in that clearly conditions are tightening for junk rated borrowers, but they're not tightening as much for junk rated borrowers as they are for the federal government. So there's still this sense of risk appetite out there that hasn't abated in the face of these higher rates. I think, they're going to get spanked hard for that, because the reason the risk appetite is still there is this expectation that the higher rates will be rendered moot by the forthcoming growth in the economy. That all of a sudden debt service won't be an issue for these companies that are massively levered and rolling their debt at rates that were twice what they were prior, because they're going to be awash in income from the boom in economic activity that's going to take place. But the handoff from one to the other is the key, because sure, maybe growth will pick up at some point, but it's not going to pick up tomorrow. And in the meantime, those debts are coming due tomorrow. So it's a problem. There's actually $1 trillion in corporate debt here in the US that rolls next year. There's another $1 trillion in commercial real estate tied debt that rolls. And then let's not forget about the federal government. I mean, the amount of borrowing that's coming from the Treasury because of our financing the deficits with T-bills is enormous. I mean, I came up with a number a month ago of 10 trillion in terms of 6 trillion worth of Treasury bills and 4 trillion in coupons. So, I mean, the point is the competition for capital this year is going to be fierce. But as relates to the question of how the markets can just blow past this increase in debt service that's going to happen, again, I think that it's on this hope that it will be rendered manageable by increased earnings. And the problem is that those earnings have to come immediately. And I was just reading FactSet before this, and in the fourth quarter, I think earnings are forecast to be up 11.5% or so, which is the fastest rate of earnings growth since the fourth quarter of 2021, I think. So right now, the burden of proof is on me because the earnings numbers have been good. But again, what we're doing here is we're painting the corporate sector with one brush, and that really doesn't work in the current environment. We've talked about the amount of corporate bankruptcy filings has been the largest since the global financial crisis. That clearly isn't anything that's reflected in credit spreads. However, that is the reality, and it's because these companies that are filing for bankruptcy are all small to mid-sized companies. They don't capture the attention of Wall Street. But eventually, we're going to feed up the chain, because it's not as though those bigger companies aren't also levered. And when you look at the breakdown of earnings growth, you see how enormously skewed it is between the haves and the have-nots. According to FactSet, the Mag 7 have 33% 8% earnings growth. This was year-on-year earnings growth. And excluding them, I think the average was 4%. So it's a massive schism between the two of them. And that's the top 500 companies in the country. So forget about, when you get to the Russell. In fact, you and I know this, that almost half of the Russell small caps aren't generating any profits at all. It's really a case of the haves versus the have-nots. And the question is, when do the problems of the many begin to be reflected in the fortunes of the few? How long can the Mag 7 be bulletproof while the rest of the universe is really struggling? And I guess that's a rhetorical question, but my answer to it would be, we don't know how long, but it's not forever. When you look at things like the consumer discretionary sector, earnings are up 12.8% year on year. If you take Amazon out of that, they're down 0.2%. The consumer discretionary companies are in recession, and yet you couldn't know it to look at the performance of the index. So, basically everyone's just long Amazon. That's the game. You may as well get rid of the debt ceiling because it serves no purpose whatsoever, because it always gets raised, as you said. So I think that's why Trump wants to get rid of it, because we play these stupid games down to the wire constantly. And then at the end of the day, they always end up raising it. So it's just a lot of political theater that creates a lot of unnecessary stress and doesn't need to be there because it serves no purpose. But I do totally agree that we need to have something more stringent in place in lieu of that. And there has been, over the years, proposals to enact a balanced budget amendment that actually requires to keep a balanced budget, sort of similar to what the state and local governments have, almost all of them. So that would be an idea. Of course, I don't know any politician that would vote for it. I think that's the problem. It would be sort of like asking the Federal Reserve if they would voluntarily go back on a gold standard. They're just not going to do it. It's the same idea for the federal government. And the two actually are related, because if the Fed went back on a gold standard, it would naturally constrain the ability for the government to run these massive debts, since they have no source of financing going forward. But so, yeah, the debt ceiling debate is all show, but I would love to see a constitutional amendment. Again, getting something like that passed is probably not going to happen. And if it did, the near-term pain associated with something like that would be pretty severe. I love the idea. Again, I come back to sort of that Federal Reserve analogy of, maybe getting some people who are not ivory tower academicians at the Federal Reserve. It would be equally nice to have some people that aren't career politicians working in Washington, and having a cabinet that's comprised of people who have actually run businesses, who understand how it actually works and have dealt with the regulatory state, et cetera, is all hugely positive. But again, we come back to the question of, how do you implement these policies? How do you create a consensus among the people who have that business background and the people in DC, the elected representatives, who actually have to get that into some policy that can be enacted? That interplay is going to be interesting to see unfold. And this idea, that it's all going to be so easy seems overly sanguine. Everyone has their political interests, and they're still going to be looking out for that, even if Elon Musk and Vivek are trying to get them to pursue some real belt tightening there. It's going to be interesting to see how that all plays out. Hopefully they will be able to really get something accomplished. There's a lot of talk from both sides of the aisle about the willingness to impose some fiscal discipline and how things have gotten out of control. But, we've heard that talk before, and right. Here we are at 36 trillion. So, I definitely don't think that $2 trillion savings number that I think Elon Musk talked about with Doge is going to be anywhere close to what they're actually able to accomplish. I think if they were able to shave $200-300 billion, that would be a triumph. It's going to end up being far less material, I think, than they have suggested. I remember looking at what the total payroll of federal government employees was, and it's $700 billion or something like that. So even if you fired everybody on the federal payroll, you still wouldn't come anywhere close to what they're suggesting. The problem with all of the federal government bloat is that every department is incentivized to grow, not to shrink. The more employees you have, the bigger your budget, the more projects. That's the incentive. All the incentive structure is designed to support growth, not contraction. And so they're going to have to turn the incentive structure on its head, which probably isn't going to be super easy and certainly won't happen overnight. There's just another area where the markets seem to be believing that it's going to be really easy and quick, and that's not going to be the case. And in the meantime, they're going to have to deal with this headwind of higher interest rates and the stronger dollar and higher oil prices, and all those realities are pressing harder and harder every day. I feel like we may already be selling the news. It just feels like the markets have been trading pretty heavy, and while the spreads are still very tight, they have started to creep higher. We have junk yields back at 7.5%, which is, a pretty meaningful yield. We are seeing a little bit hints around the edges, let's say, of some risk aversion. And obviously we had, 5 days in a row with the markets down. So I think that if they haven't sold on the news already, sure, January 21st is just as good a day as any. I agree with the broader thesis that the anticipation of Trump 2.0 was exhilarating. The reality may prove to be definitely more enjoyable for the economy and the markets than the alternative would have been, and hopefully really good long term. But I think we've discounted so much of what's going to happen forward that it's going to be rough sledding for a little while. I had asked myself this rhetorical question at the end of last year when I was looking back on 2024 and the recession that never arrived. But so I sort of had this, if a tree falls in the woods, if no one's around, does it make a sound sort of question? Because while in 2024, by the NBER standards and by the real GDP measure produced by the BEA, we did not have a recession. When you look at corporate bankruptcy filings and consumer credit card delinquencies and the downtrend in real retail sales and, any myriad number of indicators, that leading indicators, the 1 million decline in full-time employment, all of those things are the worst since any recession. And in the case of the delinquencies and bankruptcy filings, the worst since the worst recession in our lifetimes in 2008-9. So ostensibly, the economy was not in recession. But if every indicator out there other than the one real GDP measure that the government produces is screaming that we're in a recession, the rhetorical question I ask myself is, does it matter? When you look at the markets in 2024, the answer would seem to be no. It didn't matter that, people were falling behind in their bills and companies were folding up and, people were buying fewer units because they couldn't afford to buy more stuff at higher prices. It didn't have any bearing on asset prices. And so I asked that question to myself to try to figure out, okay, well, if we come into 2025 and growth, if anything, is going to be stronger as we get, these pro-growth policies and, the Fed at least isn't tightening, it's in theory going to keep cutting rates. Does it matter that we ever had this situation? And I guess my answer to it was sort of twofold. Number one, if it turns out that in 2025 we don't get the acceleration in growth that the markets are anticipating, then one presumes it will begin to matter. And number two, it suggests that the valuation extremes are even more profound. If you're talking about markets that have completely ignored what's going on in the underlying economy because they've believed these sort of glossy headline statistics that don't really have any bearing in the real world, then you're talking about a valuation extreme that's even more profound and a mispricing of risk that's even more profound. So it's sort of a self-satisfying intellectual endeavor that I went through, but I thought it was kind of interesting because, that was my one takeaway from 2024 is that pretty much without exception, every single major economic indicator was in recession, with the exception of real GDP. And to believe real GDP, you have to take the government's accounting of inflation. And, I think there are very few people out there on Main Street who believe that inflation was really 2.7% year on year. That would just be my guess.